Hi everyone, welcome to our CS Executive Accounts lectures. Okay, today we are starting with a new lesson again, lesson number 6 as per the index I have given you all. Again, it is a part of your lesson number 3 only in your module. Okay, chapter 3 of your module, corporate and management accounts subject. Okay, part A. Now today, since we have already done with issue of shares, okay, issue of equity shares we have already been through, like how the issue takes place, application, allotment, first call, final call, then we had share for feature, reissue again. We have already done equity shares. Okay, now generally whenever the equity shares are issued, equity shareholders are known as the owners. They are there with the company until the liquidation. Okay, but say suppose a company, say the company's name is Aman Limited. Okay, they already have a capital of rupees 2 lakhs, which is in the form of 20,000 shares of rupees 10 each. Okay, now this amount of capital, the company does not need right now so much of capital. They want to reduce their share capital. Okay, so in equity shares, you cannot redeem equity shares unlike preference shares. Preference shares are always with a fixed term. Okay, like a bank loan. When that term is over, you are supposed to repay the preference shareholders. Okay, but in equity shares, we always do buyback. The company buys its own shares for the purpose of cancellation. Okay, there is only one purpose, that is for the purpose of cancellation. They do not require this additional share capital. Right now they are not doing any kind of expansion plans, nothing they are looking at. Okay, so they basically want to reduce their share capital, so they do a buyback of shares. Out of this 2 lakhs, say out of 20,000, they do a buyback of only 5,000 shares. Okay, buyback of 5,000 shares of rupees 10 each. Now, one very simple understanding is that if a company is doing a buyback, they will require this rupees 50,000 to give it to the shareholders. Correct? Now, this rupees 50,000, they have a choice. They can either, okay, give it from the reserves. Reserves also is whose money? Reserves and surplus, which is there. It is the money belonging to the shareholders. Or they can make a fresh issue of other class of share. Other class means again not the same class, like not again share of rupees 10 each. They can make another class of share, like say they can do a fresh issue of preference shares. If they do not have that much of money in their reserves and surplus, then Company Act has given them this, that they can either do it from their reserves if they have that. If not from reserves, they can make a fresh issue of some other class of shares. And if wanted, they can even use a combination of both. Okay, combination. Some from fresh issue, some amount they can redeem it, some amount they can buy back with the help of reserves. Okay, now which reserves can I use? Okay, as per section 68 under Company Act 2013. Okay, it states that the company can buy back its shares from its security premium, account, money in the security premium. They can use this, plus they can use the other free reserves. Okay, it is written. Alright, or else they can do a fresh issue. Now, whenever this buyback takes place, this buyback also, company has said that you can do a buyback at par or at premium. Okay, at par means rupees 10 is the face value. The buyback also, the company will also give it as per rupees 10. Okay, so at par. Company has to pay money. Okay, this time company is not collecting money. So at par means face value is also the same and the buyback price is also the same. Buyback price is the same as its face value. Therefore, I will say it is at par. But at premium means that the company is paying something extra over and above the face value. Okay, so where the buyback price is basically more than the face value, then I will say it is at a premium. For example, say face value is 10 and I am doing a buyback at 20 rupees. I am giving 10 rupees extra to my equity shareholders. Okay, so for the buyback also they send the letter of offer to the shareholders, asking them whether they would like to tender their shares back to the company so that the company can buy it from them and reduce its share capital. It is as simple as that. Now, one important thing, okay, I will also take you all to the journal entries, but just see this, okay. Say suppose this is my balance sheet, okay. I am taking the example of Unlimited, right? We are doing a buyback of 5,000 shares of rupees 10 each. Okay? This is my liability. This is my assets. Okay, this is an example. You can write this example that the buyback is taken place from the reserves which we already have. Free reserves, general reserve, P&L account, all those reserves. Usme se I am doing buyback. Okay. So now the equity share capital, it was 2 lakhs. When the capital comes in, cash also comes in, 2 lakhs. Now I am doing a buyback. Basically I am reducing it. Okay. So when I will reduce it, okay, I am using my reserves and surplus for the purpose of reducing my share capital. Okay. So from my reserves and surplus, I am going to use 5,000 into 10, that is 50,000. So reserves and surplus will decrease. Similarly, cash will also decrease by rupees 50,000, as well as equity share capital will also decrease. Understand again, once again. Okay, I am doing a buyback of 5,000 shares of rupees 10 each from my reserves. My equity share capital was at 2 lakhs. If there is 2 lakhs, I have written cash also 2 lakhs. Okay, I am just giving you all an example. Company over the years must have made the reserves. I am saying I am doing the buyback from reserves. So my reserves will decrease. My equity share capital will also decrease. Obviously, I have to pay cash to my shareholders. My cash will also decrease, because of which my balance sheet will not tally. Okay, therefore as per Company Act, okay, this is how the principle of the accounts is also. Okay, as per Company Act 2013, they are saying that if you are using reserves and surplus for the purpose of buyback, then that amount which you are using, transfer it to capital redemption reserve, just to show it in the books for the purpose of getting your balance sheet tallied. You transfer that much of amount to CRR, make another reserve which actually does not have any money in it. Okay, it does not have some amount in it. It is just to show it. It is a notional reserve to show it in your balance sheet. Okay, where the investors, the authorities, the regulators, they come to know, oh yes, CRR is existing in this balance sheet. That means the company has done buyback or they have done redemption of preference shares. Once you understand this chapter, redemption of preference shares is also the same thing, okay? Or they have done redemption of preference shares. Okay, by looking at the balance sheet itself, you will come to know. Okay, it does not have any kind of money in it. It is just a notional account, okay, like a COCA account, just to make it to tally the balance sheet. That is why, when we do a bonus issue, what are we doing? We are doing capitalization of reserves. Okay, वैसे भी there is nothing to be given or taken from the shareholders in case of bonus. You are just converting your reserves and making it as a capital, okay, to just show it in the books, correct? It is just a book entry, right? Your capital increases without taking money, free of cost. That is why in a bonus, I had given you all this C, S, C, O, D, the hierarchy. In that C, first C was CRR. पहले CRR यूज कर लो, बोनस दे दो उसी में से. Okay, so CRR also will get, it will vanish from your balance sheet. Capital will also increase. You will give bonus also. Shareholders are also happy. Okay, so this is how, when you do buyback with the help of reserves, you have to transfer that amount to a capital redemption reserve at nominal value. At nominal value. That you will understand as and when we will do a sum. Okay, so once again, just coming quickly, okay, I will then show you the journal entries. We are doing buyback of equity shares. Buyback means when the company buys its own shares from the shareholders for the purpose of immediate cancellation. Okay, our example is Aman Limited. We are buying back 5,000 shares of rupees 10 each. Therefore, company will need rupees 50,000. Company has a choice. They can use their reserves and surplus. They can make a fresh issue of some other class of shares, or they can do a combination. Okay. Now, buyback is allowed. Whenever we are using reserves and surplus, we can also use security premium account. Okay. Buyback can be done at par or at premium. When the buyback price is greater than the face value, then I will say the buyback is at a premium. Or the company can do the buyback at par itself. Okay. Now, if the company is using its reserves and surplus for the purpose of buyback, then they have to transfer that amount which they have utilized from their reserves to capital redemption reserve at nominal value. Alright. Now coming to the journal entries. Okay. Very simple. There are only 4 journal entries in case of buyback. 4 to 5 maximum. Okay, other additional journal entries in case it may be there. Okay, now journal entries. Now say suppose I'm doing Aman Limited only. Now for the purpose of having cash in the business, okay, so that they can do a buyback. The companies generally sell their investments, okay, so that there is, the investments which they have kept, they sell that so that the cash comes in. So you can have certain additional journal entries. Otherwise, there are these 4 journal entries. Firstly, okay, it is equity, share capital, account debit. This is the journal entry for the due, amount due. If in case I am giving them premium, there will be premium on buyback. If the company is giving them premium. To equity shareholders. Simple. This is the due. Then the payment. I have to pay cash. So it will be equity, shareholders, account debit to cash. Means to cash or bank. Payment is done. Okay. Now in case I am doing my buyback with the help of a reserve. Okay. So I am supposed to transfer that amount of reserve to CRR. Okay. So reserves, free reserve, any of the free reserve. In that free reserve, you can have general reserve, you can have P&L account, any of the free reserve which you are using to capital redemption reserve account. Okay? This is the third journal entry at nominal value when I am using my reserves for the purpose of buyback. Also, I have my premium on buyback. That premium also I have to write it off. No, it is an expense for the company. That expense the company will have to write it off. From where you are giving premium? What account did you use? Okay, so generally we use securities premium account. Okay, so you can use securities premium account, or you can use any other reserve if you do not have securities premium account to premium on buyback. These are the basic 4 journal entries which we have to pass. Okay, but say suppose I am doing the buyback completely with the help of a fresh issue. Okay, I am not using my reserves. So if I am doing from fresh issue, so obviously I am going to get some money in my bank account. So bank account debit to whichever fresh issue I have done, whether I have done equity share capital or a preference share capital, whatever would be my fresh issue. So this journal entry is for the fresh issue. Okay, this is to write off premium on buyback. Correct? This is for transfer to CRR. Okay, the first one was the due journal entry, then the payment, then the transfer, then the writing off of premium on buyback. Generally, if there is a fresh issue, we will take the journal entry, the fresh issue journal entry first. Normal logic. Okay, bank account mein first I will take the money and then I will pay the money. Okay, so if there is a fresh issue, we will take the fresh issue journal entry at the starting of the sum. Am I clear with this much? Okay, now one last thing. Okay, now there are certain conditions for buyback which is given again in our Companies Act. Okay, so Company Act 2013. Okay, they have given certain conditions for buyback. These conditions are important. Okay, now the first condition, they are saying that whenever a company is doing buyback, okay, they have to first calculate these 3 conditions, and whichever is the least of the three, that much of buyback is allowed. Only that buyback is allowed, only that amount. Okay, so now what is those conditions? Okay, firstly, they say that in a given financial year, okay, the buyback basically should not exceed 25% of its paid up capital plus free reserves. Okay, aggregate of the paid up capital plus free reserves. Also there okay, the amount, like, let me take an example for this. Okay, I'll just take you with an example. We'll understand this better. Okay, this is problem number 3. So we will finish this problem also, and this is an example. Like, there are 3 situations in this sum itself. Okay, see this. NSZ Limited, it is a non-listed company. They have the following capital structure. They have equity share capital ₹10 each, fully paid up. Amount is in crores. Right now, do not get confused. We will take this amount, 330 rupees. Okay, 330 crores. Okay. Now in reserves and surplus, we are having general reserve 240, securities premium account I have 90, profit and loss I have 90, and infrastructure development reserve I have 180 rupees. Loan funds, okay, bank loan, whatever loan, is 1800 crores. Okay. Now the shareholders of NSZ Limited, on the recommendation of their board of directors, have approved on 12th of September 2019 a proposal to buy back the maximum permissible, see this, maximum permissible number of equity shares. They are not giving us the number of equity shares to buy back. Okay, they are telling us maximum permissible equity shares considering the large surplus funds which are available with the company. The prevailing market value of the company share is 25 rupees per share, and in order to induce the existing shareholders, okay, to what will excite them? When will they participate in this buyback if I'm giving something more than the market price? Right. So what are they doing? They are giving the buyback price. They have decided the buyback price to be 20% over the market price. Okay, so they are giving additional 20% than the market price. You are also informed that the infrastructure development reserve is created to satisfy the Income Tax Act requirement. So this is a statutory reserve. You cannot use this freely for buyback and all that. Okay, it is as per the act. You are required to compute the maximum number of shares that can be bought back in the light of above information. And also under the situation where the loan funds of the company are rupees 1800 crore, second situation 1200 crores, and the last is 1500 crores. Okay, so first I'll start with this 1800 crores because that is what is the sum about. Okay, first sum, the first situation where my loan funds are 1800 crores and I want to buy back the shares of the company. So let's see this. Okay, answer number 3. I have solved this for you in the books of NSZ Limited. Okay, first situation, in this situation the loan funds are 1800 crores. Okay, now there are 3 conditions for the buyback. The least of the 3 conditions, that will be the amount which is eligible for buyback, that much is permissible. Okay, the buyback of the equity shares, first condition, the buyback of equity shares in any financial year should not exceed 25% of its total paid up capital in that financial year. Okay, so if I am saying total paid up capital, I have my total paid up capital 330. I have to calculate 25% of 330. That will come to rupees 82.5 crores. Okay, 82.5 crore rupees, 25% of my paid up capital, total paid up capital. Second condition, 25% of the aggregate of the paid up capital plus free reserve. Aggregate means total. So first I will do the total, how much is my paid up capital plus all my free reserves, and of that I will take 25%. Okay, so I have my paid up capital 330, and which are my free reserves? My free reserves are general reserve. Okay, then I have my securities premium account and profit and loss account. Okay, so basically it will be 330 crores plus 240 plus 90 crores and plus another 90 crores. It will be 90 crores of securities premium account and 90 of the profit and loss account. Okay, infrastructure development reserve is not a free reserve. So now I'll do the total. Total of 330 plus 240 plus 90 plus 90 and 25% of this total comes up to 187.5 crore. Second condition is also solved. Okay, first total of the paid up capital and into that 25%, and the next is paid up capital plus free reserves of that 25%. Now the third condition, the ratio, we have to find the ratio of the aggregate of secured and unsecured loan debt owed by the company after the buyback is not more than twice its paid up capital and free reserves. Means it should be less than or equal to 2. Okay, the outside loan, the secured and unsecured loan, it is known as the owed capital of the company, should not be more than 2 times of its paid up capital and free reserve. So I have to calculate this third condition. Okay, now in this question they have stated that the company has surplus funds to dispose of. Therefore I am assuming that the buyback is also out of free reserves and securities premium. Therefore a sum equal to the nominal value of the shares bought back has to be transferred to the capital redemption reserve account. Okay, let's move to the following, solving of this third condition. Now first I will see my buyback price. market price plus 20% they are giving. That means market price into 120%, no? That will become rupees 30 per share. If you will do 25 into 20%, okay, and add that to 25 again, it will come 30 only, 30 rupees per share. I am giving more than the market price, out of which now rupees 10 is my nominal value. How I came to know? Here it is given, no? Nominal value is 10 rupees. Therefore, how much is the premium of buyback? Rupees 20 is my buyback premium. Okay. The amount of the nominal value has to be transferred to CRR. Now, I don't know only the number of shares to be bought back. So, I will assume, let the nominal value of the amount of the shares to be bought back be X, because I don't know this. They have not given me in the sum. Equal amount will be transferred to CRR. Okay. Premium on buyback. If I see this, 10 is nominal value, premium is 20. Therefore, premium on buyback is basically 2x, no? If the buyback value is x, therefore premium on buyback is 2x. So, condition number 3, secured. This is how we will solve the condition number 3. Okay, in form of a equation. Secured plus unsecured debts upon paid up capital plus free reserve should be less than or at maximum equal to be 2. Now, let the amount of the buyback be x. I have already assumed. Okay. If the amount of buyback is x, now I will put it in my equation. Secured plus unsecured debt. In my sum, it is only 1800. So, I have put here 1800. Paid up capital after the buyback. I have to take the paid up capital after buyback. So, 330 minus x, buyback हो जाएगा. Buyback amount I am assuming है x. So, 330 minus x. Plus I am doing buyback from my free reserves. Therefore, 240 plus 90 minus x minus premium also have to pay, no, from my reserves. Correct now? So, 240 plus 90 minus the buyback amount, also minus the premium on buyback amount. That should be equal to 2. Now, solve the equation. 1800 upon 750 minus 4x is equal to 2. When I will solve it further, I will come to this point where x will come as minus 37.5. Now, this minus 37.5, it means amount of the nominal value of the shares that can be bought back is nil, is 0. Okay. When I am getting an amount of x in negative, that means the amount of buyback which I can do, nominal value of the buyback, nominal value, face value of the shares that can be bought back is 0. Since from all the conditions 0 is the least, from all this condition 0 is the least. First condition I got 82.75. Second condition I got 187.5. Last is 0. Since from all the 3 conditions minimum amount is 0, hence buyback cannot happen when company has the loan funds of rupees 1800 crores. This is the conclusion. Okay. I am going to do the other 2 situations also. Okay. Now, in situation number 2, say for me situation number 2, here my loan funds are becoming 1200 crores. Let's see. Everything will remain the same. My condition number 1 will be 25% of the total paid up capital, 82.5. Condition number 2, 25% of paid up capital plus free reserve, 187.5. But my condition number 3 is going to change. How? We will see this. Okay. Now, in case of situation 2, your x, when you will calculate x, okay, similarly, same thing, instead of 1800, I will now have over here 1200. I have to assume everything the same. Let the nominal value of the buyback shares be x. Therefore, my premium on buyback will be 2x. I already found out, no, the premium amount and the nominal value. Okay, now when I'll put it in my equation, it will be 1200. Okay, upon, after I solve this entire thing, it will be 750 minus 4x, which will be equal to 2. Further solving it, I'll get 1200 will be 2 into 750 minus 4x. Here when I'll solve it, I'll guess x is equal to, x will be equal to 37.5. 37.5 crores. This is the least of all the three conditions. Okay, therefore number of shares which I can buy back means I can use this much amount. This is the least of the amount can be used for the purpose of buyback. Number of shares that can be bought back will be the amount divided by the face value of the shares, divided by the face value. Amount, the least of the amount from the given three conditions, divided by the face value. That will be 3.75 crore shares can be bought back. Am I clear? So when the loan funds changed, okay, to 1200 rupees, loan funds were less, and I solved my third situation. In the third situation, it is nothing. You have to just find the nominal value, which is already given in the sum, and the premium on buyback. Nominal value of the shares, the amount of the nominal value of the amount, okay, can be assumed as x. Therefore my premium will be 2x. Once I put this in my equation, I'll get my value x. X is nothing but the amount of the total amount, okay, in crores, in rupees, not number of shares. Nominal value of the amount of the shares that can be bought back is x. Out of those three, this was my least of the condition. I divided that with my nominal value. I got my number of shares to be bought back. Okay, and when the loan funds become 1500 crores, again the same thing, you will get x equal to 0. So the least of the three conditions is 0. Therefore no buyback can take place. Company cannot do a buyback as per Company Act 2013. Am I clear with this sum? It is a very, very important sum.
Yes, ma'am.
Okay, any doubt you will have? Because apart from this, all the other sums are just basic journal entries. So this is what is important, really. These three conditions as per Company Act. Okay. Chalo. Now we'll solve other most few sums. Okay, to get our journal entries clear. Okay. Chalo. Question number 1. Let's start with this first sum. The following is the balance sheet of ABC Limited. Now in this sum they will give us how many shares to buy back and all. Okay. They are saying equity shares of rupees 10 each, 50 lakhs. Then general reserve I have 15 lakhs. Profit and loss account also I have money. Securities premium also I have got money. In secured loans I have debentures and current liabilities. May I have creditors and bills payable. Okay. In assets, non-current assets mein we have fixed assets and investments, and in current assets we have cash and bank balance, stock and debtors. Here the company decided to buy back 1 lakh equity shares of rupees 10 each at a premium of 25%. They diya hai 1 lakh equity shares buyback karo. Buyback price also they have given. Okay, face value is 10 plus give them 25% premium on 10. For this purpose, the company sold their investments, which investments are at rupees 6 lakhs, and made a fresh issue of 10% preference shares of rupees 100 each to the extent minimum after utilizing the securities premium account and half of general reserve. So now they have not given me number of preference shares to be issued. Fresh issue also they are doing, and they are using reserves and surplus also. Okay, so for the fresh issue they are telling me that to the extent minimum do the fresh issue as minimum as possible. So we have to first journalize the transaction, and lastly calculate the post buyback debt equity ratio. ठीक है. Okay, I'll first take you all to the working note. Okay. Calculation of number of preference shares to be issued. Okay, this will be a working note always. Right, this only we will be preparing. First, write amount required for buyback. I have to buy back 1 lakh shares at rupees 10 each face value. Plus I have to give them 25% premium. This is mentioned in my sum given. So I have to pay my shareholders 10 lakhs plus 2,50,000. Am I clear over here? Okay. Now I am doing the buyback with the help of fresh issue plus DP transfer to CRR. DP transfer to CRR means divisible profit transferred to CRR. Why? Because I am using my reserves and surplus also. Okay. So I do not know my fresh issue amount. They are saying first utilize your reserves. ठीक है. How am I supposed to utilize the reserves? What reserves I have? I have general reserve 15 lakhs, but in that they are telling me utilize only half of it. So I can utilize 7 lakh 50. In my P&L I have got 1 lakh, and my securities premium also I've got 1 lakh. ठीक है. Okay. Come to this. Securities premium account. I can get some from fresh issue, and when I do a fresh issue I can do at premium, and some amount will be there in my balance sheet, but fresh issue is at par. Okay, it's not at premium, so nil, and in my balance sheet I already have 1 lakh, so total is 1 lakh, but the premium which I have to give on buyback is 2,50,000. So this 1,50,000 from where I will take? Balance 1,50,000. I will remove it and use it from my P&L. ठीक है, 1,50,000 I will use it from my P&L. I do not have that much money in my security premium. So now I will calculate how much P&L I have. P&L balance sheet में 1 lakh है. Then one important thing is I had sold my investments at rupees 6 lakhs. If you see here, but my investment value is 5 lakhs. That means there is a profit of 1 lakh. 1 lakh rupees is the profit. That will go to P&L. So investment profit also 1 lakh. Total is 2 lakhs. Out of which I have to use 1,50,000 for premium on buyback. So now I am left with only 50,000 in my P&L. Okay. General reserve, they have told me use only half. So 7,50,000. P&L I am now left only with 50. So I can use total 8 lakhs from my DP transfer to CRR will be 8 lakhs. So how much will be my fresh issue? To find my fresh issue, I will always compare this nominal value with this nominal value. Okay. So it will be 10 lakhs total. Total is 10 lakhs, no? Minus 8 lakhs I am using from my reserves. So 2 lakhs will be my fresh issue. Okay. What is the value of one share? 100 rupees. So number of preference shares which I will issue will be 200. No, sorry, 2000. 2000 preference shares will be issued to the new preference shareholders. Okay, for the purpose of buyback. So journal entry, the first one is for the sale of investment. Bank account debit, I am going to get 6 lakhs. Value of investment in the balance sheet is only 5 lakhs. Therefore, this is profit on sale of investment 1 lakh rupees. Fresh issue of preference shares. What is the name of the preference shares? 10% preference shares. Okay. So bank account debit to 10% preference share capital account. 2000 shares into 100. Okay. 2 lakh rupees being fresh issue made. Then we have the normal journal entry, equity share capital account debit. Then we have securities premium account debit. Okay. Also, I am going to use my P&L for this 1,50,000. Okay, so I could have either written equity share capital account debit, premium on buyback account debit, to equity shareholders. This is also okay, and direct journal entry is also okay. Instead of writing premium on buyback, I have directly written securities premium and P&L, writing it off directly from here only. You can do it this way also, or you can pass this journal entry and then later on you can write it off. Write it off with the help of securities premium account, profit and loss account to premium on buyback. From securities premium I used 1 lakh. Okay, and from P&L I used 1,50,000. So to premium on buyback will be 2,50,000. This is also okay, like how I showed you all my journal entries, and even this is okay. Why I am doing these two things? So that when you solve your MCQs, okay, and then something like this is given, you will say ma'am ne to nahi sikhaya. Okay, so ye, it is a combined journal entry. Equity share capital 10 lakhs. Securities premium I already have. This is for the premium on buyback. So I am using my premium account, P&L account to equity shareholders. Equity shareholders account debit to bank. And lastly, I'll transfer from my DP transfer to CRR. General reserve account debit, P&L account debit to capital redemption reserve account. Fine with this sum? Simple. I have to find my post buyback debt equity ratio, post buyback, after the buyback is over. So what will be my debt equity ratio? Secured plus unsecured debt upon paid up capital plus free reserve. Secured and unsecured debt kitna hai? First is 4 lakh secured, 10% debentures, and unsecured mein I have another 10 lakh, 7 plus 3. Unsecured, no? This is unsecured. This is secured, it is already given. So I have 4 lakhs plus 10 lakhs. Divide by paid up capital plus free reserves. In free reserves, I have already used my P&L. I have already used my securities premium. Only general reserve 7 lakh 50 is left. Also, equity shares I have bought back, no? Equity shares I have bought back. So paid up capital will now be 50 lakhs. Okay, minus I bought back 10 lakhs plus fresh issue of 2 lakhs of preference shares. Okay, so first initial equity share capital, then this is the buyback, and then this is the fresh issue. So I am left with 42 lakhs now of paid up share capital. In paid up share capital, both the capital are included, okay, equity share capital and preference share capital. Okay, so 42 lakhs plus 7 lakh 50,000. When I'll solve this, I get 0.28. Since the post debt equity ratio is less than 2, provisions of section 68 of the Company Act has been complied with. Conditions given for buyback is complied with. Okay, I'm moving to question number 2 now. Okay. Following is the balance sheet of Light Limited as on 31st of March 2018. Shareholders funds equity shares of rupees 10 each, amount is in rupees in lakhs. Okay, so 10, securities premium 2.4, reserves 7.5, profit and loss account 2.8. Non-current liabilities I have debentures 16, and in current liabilities I have creditors 4.3. Assets, non-current assets I have fixed assets 20.4, trading investments 4.2. Sorry, non-trading investments. Current assets, stock, debtors, bank. Total is 43 lakhs. The company has bought back 15,000 shares at rupees 40 each. Okay, number of shares is also given, buyback price is also given. The transaction in respect of buyback was financed by sale of 2/3 of the non-trade investments. So 2/3 of this I am going to sell it for rupees 5.9 lakhs. Show important accounting entries in the books of company to record buyback. Now here they have not told me any fresh issue. So I will not do a fresh issue. Simple. Okay. I'll first write this. My working note, important working note, सबसे important. Amount required for buyback is equal to fresh issue plus DP transferred to CRR. Amount required for buyback 15,000 shares of rupees 10 each है. Face value rupees 10 each. Okay, but I'm giving them 30 rupees premium. Why? Because buyback price is 40 rupees. Sorry, 40 rupees. Therefore premium is 30 na. So total I am going to give them 1,50,000 plus 4,50,000. Fresh issue है ही नहीं, nil. DP transferred to CRR, that we will see now. First I will just treat my securities premium. Securities premium, balance sheet plus fresh issue. Balance sheet security premium is 2.4. Okay, plus fresh issue में तो nil. Premium on buyback I require 4.5. That means 2.1 is yet to be removed from somewhere. From where will I take it? From my P&L account. Now my P&L account, balance sheet plus sale of investment. There is a profit in my sale of investment. Okay. In my balance sheet, my P&L is already 2.8. And profit on sale of investment, I have got 3.10. Now, how did I get this profit? Okay. Non-trading investment, I am selling 2/3 of this non-trading investment. So, calculate that 2/3 of 4.2. 4.2 means 4 lakh into 2 divided by 3. So, I am selling this 2.8 of my non-trading investment at for rupees 5.9 lakhs. Okay, so 5.9 minus 2.8 will be 3.1 will be my profit. Okay, so you can write it over here if you want to. Sale of investment. Okay, 4.2 into 2 upon 3 is nothing but 2.8. Selling price of this investment is 5.9. Therefore, profit is 3.1. Okay. Sale of investment. So, now profit and loss account, total amount I have 5.9. From which I have to remove premium on buyback 2.10, 2.1. So, now I have a balance of 3.8 in my P&L account, which I can take in the balance sheet. Okay. Now, I require 1.5 nominal value only. Premium I have already adjusted over. I will always compare nominal value. Nominal value of the amount of buyback should be transferred to CRR. Now I have enough money in my P&L also, and I have enough money in my general reserves also. In reserves also, I can use whatever I want to, because I just need 1.5. 1,50,000, huh? So I need 1.5. So I am using 1.5 from my general reserve. General reserve में से I'll use 1.5. So now in my balance sheet, in my general reserve, I'll be left with 6 lakhs. It's your choice. You can use it from P&L also. There is no harm. Okay, so 7.5 minus 1.56. Okay, now just pass the journal entries. First, bank account debit to investment account 2.8. From where did I get the 2.8? 4.2 into 2 by 3. Profit and loss account. This is the selling price of the investment. Equity share capital, nominal value, at nominal value to be bought back is 15,000 shares at rupees 10 each. Okay, then there is a premium of rupees 30. Okay, which comes up to 4,50,000. That I am writing off with the help of securities premium account and P&L account to equity shareholders. Equity shareholders account debit to bank. Payment of 6 lakhs. How? 1,50,000 on nominal plus 4,50,000 on premium. Then DP transferred to CRR. I am using reserves account. Reserves account debit to CRR. Question number 2 is done. Any doubt so far?
No.
Okay. Question number 3 I have already solved now. Now coming to question number 4. Sure. Question number 4 is more like an MCQ type. Okay. It's not the whole sum you have to solve. Let's see how it is. S Limited decided to buy back 2000 equity shares of rupees 100 each at a premium of 10%. Okay. For this purpose of redemption, company issued 15,000 10% preference shares of rupees 10 each at a premium of 20 per share. Yani fresh issue is also at a premium now. The company has sufficient balance in their P&L account. At the time of buyback, the amount to be transferred to the company CRR account will be how much? These are all your MCQs. How much is to be transferred to CRR? Okay. Equity share capital which I require to buy back, they have told me 2000 shares at rupees 100 each, but I am giving them buyback premium. Okay. But I will always compare nominal value. So for me, nominal value for the buyback is 2 lakhs. Fresh issue, how much I am doing? 15,000 shares of rupees 10 each, but at a premium of 10 rupees. If I do 20% premium, it will become 12 rupees. Okay, so 15,000 shares at rupees 12, 1,80,000. Therefore, out of P&L means DP transferred to CRR will be only 20,000. Okay, 20,000 will be transferred to CRR. This is the same thing like how I used to write now. Amount required for buyback is nothing but it is equal to fresh issue plus DP transferred to CRR. ठीक है? Amount required for buyback is nothing but 2000 into 100, which is 2 lakhs, plus there is a premium on buyback. Premium on buyback is 10%, no? So 20,000. Okay, fresh issue I am doing 15,000. Now this fresh issue is also at a premium. Fresh issue into 15,000 into 12, it comes at 1,80,000. Okay. Now DP transfer to CRR they want. This is what they want. Okay. So I will compare my nominal value of the buyback. I am already doing a fresh issue of 1,80,000. So how much I will need for my reserves? 20,000. 20,000 will be DP transferred to CRR. Okay. Here I am using the premium amount also because buyback can take place from premium. You can use the securities premium account for the buyback of equity shares. Alright, they have already told me there is enough money in my P&L account. Okay, enough money in my profit and loss account. That means I'll be able to write off this premium also, and I'll be able to, because when I'm writing off this premium, obviously I'll write it off with the help of my P&L account. So there is a lot of money in my P&L account. Alright, question number 4. There are many such sums in your scanner, like this question number 4. Now see this question number 5. During the year 2018 and 19, T Limited did a buyback of 20,000 equity shares of rupees 10 each, again at a premium of 5%. During the year 18-19, the company did not have sufficient cash resources to buy back these shares. Therefore, it issued 1,12% preference shares of rupees 10 each, which is at again a premium of 15%. However, the company has sufficient balance in the general reserve account. Find the amount to be transferred to CRR. Simple. Again, the same equation. Amount required for buyback is fresh issue plus DP transferred to CRR. 20,000 shares of rupees 100 each, 20 lakhs, plus premium on buyback is 5%. That means 1 lakh I have to give on premium. Fresh issue they are doing 1 lakh preference shares of rupees 10 each, plus securities premium account I will get, no, I'll get premium on my fresh issue 15%. So 1,50,000. Okay. Now my securities premium, I have 1,50,000. Premium on buyback I have to give is 1 lakh. So 50,000 I still have balance in my securities premium account. I can use that for my buyback also, no? Securities premium account can be used for the purpose of buyback. So now DP transferred to CRR at nominal value, I'll compare. Nominal value is 20 lakhs minus nominal value of fresh issue is 10 lakhs. So now this 10 lakhs, okay, I need more from the DP. So I have securities premium 50 lakhs. So from the PNL account I will use will be 9,50,000. So my DP transferred to CRR will be 9,50,000. Okay. You can directly do it like this also, like how we did in the previous sum. Okay. Nominal value to be bought back is 20 lakhs. Nominal value of buyback minus fresh issue. In fresh issue I am going to get 10 lakhs plus 1,50,000, na? So it will be 11,50,000. So this will come to 9,50,000 DP transferred to CR.
Means won't it be 8,50,000?
No, it will not be 8,50,000. Acha, okay, when I subtract 20 lakhs from 11,50,000, okay, yeah, it will be 8,50,000. No, but then I think I cannot do this. 1 minute. 1 second. Okay, so that is it with buyback of shares. Okay, now the same thing we are going to do it in with the redemption of preference shares. Only in redemption of preference shares we cannot use securities premium account. Okay, so whenever we are using securities premium account for DP transfer to CRR, like how we did in question number 4 also. If you see our question number 4, here also we have done securities premium, we have used it. We have subtracted that from the nominal value and balance we have taken to CRR. Similarly, in question number 5 also, I have taken 20 lakhs minus 11,50,000. 8,50,000 that will go to CRR. Okay. Unlike this, in preference shares, this is what does not happen. Okay. Rest everything remains the same. Premium on redemption, everything remains the same. Alright. So we will continue with redemption of preference shares in my next class. Okay. Thank you so much, everyone.